Good morning and welcome. My name is Matt Price here with Matty Kearns. Randy sends his regards, but this is our monthly market update, something that we do every month. This month will be one of the shorter versions. Our goal is to be 10, maybe 15 minutes long, have a number of slides on what we think is going on in the markets, the economy, etc. Our goal is not necessarily to go into a deep dive on all of this. Our hope is this might provoke a few questions, comments, even snide remarks to whether it's email, phone calls down the road. So our attempt to kind of keep you updated month over month, but quite a few clients on here, a few new names as well. Who we are, Randy, he tries to tell me he's my older brother. Don't let him fool you. I'm Matt. Matty is on here as well. We have a niche in retirement. Over 80% of our clients are retired. We think it's really important. We follow the fiduciary standard, putting the needs of the clients first. Not everyone in our industry does that. We think it is paramount of utmost importance when in our industry.
A little bit more about the Price Group. You'll see there on the left accolades, bragging on Randy, Matt, and the team. Honored to be recognized by Barron's, Financial Times, Forbes. Randy was recently named to the Best in State Wealth Advisor list for 2024, fifth time in the last 6 years. So proud of Randy for that. And we also value education. I think our clients should as well. You'll see that there. Randy, Matt, and myself, we are all CFP professionals. Randy and Matt hold their Certified Investment Management Analyst certifications. Again, we think that's very important from an advisor perspective. About our firm, a lot of prospective clients ask, so who's the Price Group? Who's Steward Partners? What's Raymond James? It's a good question. The Price Group, Randy, Matt, myself, our team here, we're the Houston office of Steward Partners, our firm, which operates as a fiduciary for our clients. Steward Partners had $30 billion in client assets as of the end of last year, not owned by a bank. And Raymond James is our primary custodian. They are a fiscally conservative company on the S&P 500, didn't take out any bailout funds in 2008. Clients are been satisfied with Raymond James. They get their statements, log in on their online portal, and they've been a good partner of ours. That's a little bit about us, and diving into the markets, we'll start with the Fed. If you've been on these market update calls this year, you'll recognize that there has been quite a shift. The Fed policy has been in flux all year from a market perspective, shifting dramatically. If you look at the chart at the beginning of the year, the light blue bars, the markets were expecting up to 6 cuts by the end of the year, 2 by this time. Now, current expectations are for maybe 1 to 2 cuts before the end of the year, maybe in September, more probably in November after the election. And why the change? In short, the economy has defied expectations. It's made the Fed kind of tied their hands on what they can do from a rate cut perspective. And the reason that the economy has been strong is largely due to the consumer. The consumer continues to defy expectations. If you look here at the chart on the left, retail sales, this retail sales control group is essentially all retail, less autos and more volatile items. But spending is up 6% year over year, the highest, up to the highest levels other than COVID. A bunch of quotes here from financial professionals. The consumer remains resilient. Data does not indicate any meaningful behavior change. The consumer remains strong. And you'll see here, about a year ago, the forecast was about a 1% consumer spending forecast, and now that's doubled up to 2.2%. And why is that important? That's because the consumer represents the majority of economic activity in the United States. Almost 70% of GDP is due to consumer spending. And of that, services are about double what goods are. And so it's obviously important to have a good view of consumer spending as we chart the future course of the economy.
So a quick thank you to each of you who are stimulating the economy out there at Starbucks, buying a coffee, going to the grocery store. A big help. I feel like I'm pulling my cart as well with 4 kids. We go to Costco and I kind of get to the checkout line and I can't believe how much money we spent just on diapers and go down the list of items at Costco. But like Matty said, we think the consumer continues to be healthy. What we're looking at here is maybe a disappointing start to the year from a fixed income or a bond perspective. That's what's happened in the past. Obviously, 2022, a year and a half ago, was one of the worst years for bonds for fixed income on record. Last year was a pretty decent rebound year. We think right now that bonds are really setting up to be a good investment moving forward. Why do we think that? Well, we're starting out with higher income levels, and we think that is really important. So you can lock in depending on the type of the bond, but 3, 4, even 5% on some bonds, and then hold that bond until maturity. Now, if what Matty said earlier is correct, and we do see 1, 2, maybe 3 interest rate cuts over the next 12 months or so, typically, not always, but typically you see interest rates start to move a little bit lower with that. So bring you back to your old childhood playground, the seesaw, interest rates up, bond prices down. If interest rates do move lower, that's a little bit of a tailwind for bonds for fixed income moving forward.
In addition to that, as it relates to the municipal bond market specifically, the question here, where do we see value? Around tax season, investors are typically selling assets to pay tax bills, which means demand is weaker than supply, but we're heading into a more seasonally favorable time of the year where demand exceeds supply. And so muni yields right now look pretty attractive. That's the chart here on the left, and want to point out that this chart is showing the tax equivalent yield on those bonds. As investors attempt to discern the advantages of tax-free muni bonds over a taxable corporate bond, we want to make sure we're using an apples to apples comparison, and that's why we use tax equivalent yield. You'll see
Matty,
that.
remind us what the tax equivalent yield is.
Yeah, so it's a calculation that helps to put a taxable bond and a tax-exempt bond on equal footing. So if a taxable bond is yielding 5%, but a tax-free bond, a muni bond, is yielding 3%, that 3 and 5 are not apples to apples because that 3% is tax-free. And so when you take into account the tax rate, maybe that is more like a 5% tax equivalent yield, and those are an apples to apples comparison. And so what we're showing here at a 6% yield on munis is assuming a top tax bracket of 40%. So that 6% tax-free, tax equivalent yield would be comparable to a corporate bond. And right now, 6% is near the highest that it's been, again, in the last 10 years outside of COVID. And when you look at the yield curve and try to find value along the yield curve, you see the majority of the value is in longer duration muni bonds. The dark blue line here are treasury bonds. The 2 colored lines are different kinds of muni bonds. Obviously, once you go out longer, the yield advantage is significant. And even for investors that want to take on a little bit more credit risk, some high yield muni bonds, those tax equivalent yields are up to 9.5% right now compared to treasuries at 4.6. So almost a 5% delta between those two.
And yeah, that great information. Thank you, Matty. One thing to add to maybe look at the forest is at times municipal tax-free bonds, there are periods when they become, we think, really attractive, and there's periods when they're unattractive. And the reason for that, a vast majority of the owners of municipal tax-free bonds are what we call retail owners. So think, our clients. Typically, these tax-free bonds are not owned by professional investors, pension funds, endowments, et cetera. Because of that, because they're owned by retail investors, typically the pendulum can swing a little too far in each direction. And it's our humble opinion right now, we think it's a good period of adding to some tax-free bonds. That's what we've been doing for some clients here over the past weeks, over the past months. So bottom line, we like tax-free bonds. We think the credit quality, for the most part, remains resilient. You know, we're staying away from the Californias, the New Yorks, the Illinois, things like that. But for the most part, a vast majority of the bonds that we look at in Texas and a few other states continue to function and collect revenues and taxes at expectations or above expectations. So let's spend a few minutes here, look at the earnings for companies across the market. We consider the market the S&P 500. Overall, there's a little bit of a busy chart. I want to draw your attention to the right. 79% of the companies kind of beat their expectations. That's a hair higher than what the quote-unquote normal is. We think that's a good sign, not only for the now, but also moving forward. If companies continue to beat earnings. If you go to the next slide there, the other thing that we think is really maybe optimistic, not about the next 2 weeks or 2 months of the market, but maybe about the next year or two, is if you look at the buybacks. Just a reminder what this means. These are when the corporate executives have made a decision to buy back their own stock. And they're doing that because they think it is possibly undervalued. And so typically when the market is quote unquote expensive, you see buybacks really move lower. When you think the stock is undervalued, you see an increase in some of the buybacks. So you can see here the first quarter, the first 3 months of this year, we've had slightly above average buybacks, which we think is an encouraging sign over the coming quarters, maybe even the next year or two. And then the next slide, this is something that we've written about in some of our blogs and the weekly Retirement Insider email we send out, but there's been a growing disconnect between the 10 largest stocks in the S&P 500. Think Apple, Facebook, Google, Amazon, some of the high-flying tech stocks, and then the other 490 stocks in the S&P 500. We think moving forward, you're going to see the other 490 stocks pull more of their weight. We think that should be important to clients just from a standpoint. We haven't been a huge fan of the high-flying tech stocks for a few reasons, but a majority of them don't pay dividends, and they're typically a lot more expensive than the other stocks. So the client stocks, for the most part, in our dividend growth portfolio tend to gravitate more towards the non-top 10 stocks. And so we think this is setting up to be a period where the top 10 stocks in the S&P 500 might not do as well moving forward for a number of reasons. So those are our prepared remarks right here on schedule, 12.5 minutes, but this is the team. Maybe you saw the email, maybe you didn't. Newest team member there on the left, Preston Price, one of my brothers. He's been with us for almost 2 months now, doing a great job getting certified with all his tests. Tiffany, Melissa, Randy, myself, and Maddie want to thank you for taking a few minutes with us. Like we said, hopefully this promotes a few questions, comments. We are here if you need anything, but if not, I want to thank you for coming and hope you guys have a good rest of the day. Talk to you soon. Thanks.